Okay, so we're on week 3, analyzing financial statements. So last week, a recap of that is basically we talked about what the 3 financial statements were, and we basically gave a very brief overview. So today we're going to go in depth and really understand what they actually mean. Okay, so first thing, the balance sheet. The balance sheet provides for a snapshot in time of the company's assets, liabilities, and stockholders' equity. Balance sheets provide the basis for computing rates of return for investors, as well as evaluating a company's capital structure. Capital structure meaning how much debt and equity a company has. In essence, a balance sheet shows at any given point in time what the company owns and owes, along with the amount invested by stockholders. Balance sheets are normally used in conjunction with other financial statements to make informed decisions by conducting fundamental analysis. So on the right, we have an example balance sheet that basically shows we have assets, liabilities, and stockholders' equity. And yeah, we'll go more in depth on this in the next slide. Okay, so we have assets. So we have a consolidated balance sheet. It's basically a very simplified version of one from the company Amazon. So we have assets and liabilities and stockholders' equity. So this asset represents the left side of the left side of the balance sheet, and liabilities and stockholders' equity come on the right. So again, current assets, everything the assets Amazon has had that'll turn into cash within less than a year, and then this is long-term assets. Anything the company will remain non-cash for more than a year. So you have 2016 and 2017. Okay, and then liabilities, current liabilities, basically obligations that a company is going to pay off within the year, and long-term liabilities is everything the company will hold on to for a year or more. We have stockholders' equity here. This is basically everything that the shareholders have in the company, everything involving preferred stock and common stock. That's the stake that shareholders have in the company, treasury stock as well, and then we have other fees as well. And then of course, retained earnings. Retained earnings, as we all know, is net income minus dividends, net income being revenue minus expenses. So retained earnings is revenues minus expenses minus dividends. And then right here, we have total stockholders' equity and total liability and stockholders' equity. So you see how these totals match. It's because assets equals liabilities plus stockholders' equity. And so the totals have to match. For 2016, they match, and for 2017, they also match. Right, income statement. So the income statement provides an overview of revenues, expenses, net income, and earnings per share. The income statement shows a range of time, a year for financial statements, and a quarter for quarterly financial statements. The income is the primary feature of the income statement, which is essentially as expenses subtracted from revenues. The key equation in the income statement is net income equals revenues minus expenses, and an income statement essentially helps business in determining whether profit can be generated by increasing revenues and or decreasing expenses. Here we have 2 basic examples of income statement. We'll go more in depth. Next slide. Okay, so an example of the income statement. So we have right here 3 years in an example corporation for the year ended December 31st. So we have net sales that comes in, and then cost of sales. So these are all expenses. And then so you have net sales, and you have to subtract all of these before you get your net income. So all of these are expenses in the company, and net sales counts as revenue. All right, so lastly, we have the statement of cash flows. Now, the statement of cash flows shows there's 2 sides to it: cash inflows and cash outflows. So inflows, basically all the cash that a company receives from its operations and investments. Cash outflows, all the company that pays towards business activities and investments. So there are 3 categories when you're grouping using statement of cash flows. They're called operating, investing, and financing activities. Operating activities are essentially transactions from all operational business activities. Investing activities is basically results from investment losses and gains. And financial activities is an overview of cash used from debt and equity. Here we have an example statement of cash flows. So here we have our operating activities, we have net income, all of that. So this essentially, so normally when we think about accounting, we think about accrual-based accounting. That's essentially recording things when it happened as opposed to cash received. So for the statement of cash flows, we kind of touch a little bit on cash basis accounting. Businesses, of course, have to follow accrual basis accounting because of generally accepted accounting principles. But for statement of cash flows, it makes sure that the business has enough cash on hand to pay its obligations, meaning its operating activities, meaning its debt that it has to pay back, and so on and so forth. And yeah, here is a question. So which of the following equations regarding the income is correct? Okay, so we have three. I'll just give you the answer. Is B, net income equals revenue minus expenses. And yeah, we're pretty much done for today. If you have any questions, please drop them in the chat. Otherwise, I will see you guys next week. Take care, guys.